Welcome to today's Savant Live webinar discussing unexpectedly solo, rebuilding your financial plan. We're going to cover a few different aspects about becoming unexpectedly solo for you, such as what financial decisions must be made, how you should approach them, and through proactive financial planning, we will try to help newly single people reduce the uncertainty and anxiety that goes along with this transition. Having a new financial plan will help reduce stress, aid in the healing process, and help you move forward with your life. So first, we thought you would find it interesting to find some background on how many people may find themselves unexpectedly solo. We'll identify some of the responsibilities associated with personal finance that may or may not be new to you. And we've organized these into three different roles. There's going to be the role of the CFO or Chief Financial Officer, the role of being a new investor and making decisions related about investments, and also the role of grantor philanthropist. And third, we're going to talk about decisions that the people we're calling unexpectedly solo need to make. Here, we recognize that emotions are a big part of this and can affect decision making. Finally, we'll identify some resources that we can offer that can help people undergoing such a major change in life. And then, of course, we'll have time for your questions. So as I mentioned, there are some statistics behind people who may find themselves unexpectedly solo. Of course, there's different paths to get there. Becoming a widow or widower and also potentially a divorce are the two main reasons. Now, it's clear that some women are 4 times more likely to outlive their spouse. And when that happens, the household income can change, Social Security and pension can be impacted, investment income can change. And this isn't something that happens briefly. Studies show that people can find themselves in this phase of life for 15 years or more. So making sure that you've planned for the possible premature passing of a spouse, although unsavory and unpleasant, is something that should not be overlooked. And while overall divorce rates are declining, for people 50 and up, it's doubled within the last 30 years, and 65 and up, it's tripled. So this is certainly something that we don't want to just glaze over, even if it's not fun or popular to talk about. If you find yourself in this position, you may be faced with taking a role that you're not familiar with. All of a sudden, you may need to be the CFO of your household, act like an investor, or now have to make decisions like a grantor or philanthropist. Well, how do you do this? It's likely overwhelming to think of all that needs to be done in order to organize your financial world. Every household has a different division of labor, and if you haven't been familiar with these responsibilities, it can be very anxiety-inducing. Now, if you're part of a couple and had a solid financial plan in place where you were married, perhaps that's still relevant and useful and can be used for the groundwork. Or maybe it's outdated and needs to be refreshed, and which will now need to reflect new goals and new priorities. We need to help you transition to start to think like an individual rather than a member of a couple to help develop a new path going forward. We also want to acknowledge, as mentioned, that this is not simply a financial process. There's going to be a major life change, and you may be grieving the loss of a loved one, or you may be grieving the end of your marriage. This can be very challenging, and it doesn't all happen at once. You feel like maybe you might have to make all those decisions all at once, but you don't. This is going to be a process. So immediately, what I want you to recognize is that taking a step back and allowing the grieving and emotional process is healthy. But then what we want to do is start to help get a sense of security and get your arms around everything that needs to be done. We want to meet your basic and immediate needs, help you grow and learn about this new phase of life. Because the more you learn and the more education you have, the less intimidating and scary it can be. So we want you to know that you can find allies to help you in the different areas. So whether that's a fiduciary advisor, a financial advisor, a CPA, an estate attorney, insurance agent, realtor, in fact, potentially all of those people will need to be helping you. You don't have to be an expert in everything. We want to build a team around you and help you with that. Additionally, getting organized is a really good thing to do early in the process. It starts to get your hands into everything, which can give you a sense of control. And again, if you start to lay things out, that'll help you feel like you got your arms around what's going on. So let's start with this new role as a CFO. You're going to want to gather data, know your assets, know your liabilities, sources of income, and expenses. At a minimum, you want a net worth statement and a budget. Now, we also have resources to help you gather data about your financial situation. And we like to think of that as a financial footprint that will help your family, help you if needed. Sometimes, if someone passes away and we don't have something like this, the family ends up having to be like a private investigator, stalking the mailbox for clues in order to gather the information about all the assets or get a financial snapshot. So, having a prepared guide ahead of time helps you to gather all of those assets, liabilities, income, expenses. But it's also a place where you can list information about various policies. Maybe you have multiple life insurance policies with multiple companies. There's maybe a list of people that you need to reach out to. Again, those insurance agents or realtor, memberships to cancel, credit cards, online portals, and passwords. This is a good thing that you might want to start to gather ahead of time. And obviously, it's best to do ahead of time so that when you're dealing with a traumatic event, you can focus your efforts on that type of energy. Now, Ambari, I know you have helped individuals with this phase before, and I know you have some valuable insight to add here.
Thank you, Libby. So as advisors, we help people go through major changes and have seen how a little advanced preparation can make a significant difference in reducing the potential level of stress. You know, if someone's familiar with their personal finances and the personal finances of someone they're going to take care of, it takes away the need, as you said, to figure it out all at the same time. And today, while we're focused on people who find themselves unexpectedly solo through the death or a divorce, I wanted to share a story about a client who experienced it as the adult child and during her mother's serious illness. So one of my clients is now responsible for her mom, who has Alzheimer's. There was a noticeable decline in her mother's health, and her mother lived in a different state, which combined to make a very difficult set of circumstances. Her mother wanted to stay independent as well. However, her mom was found on the bathroom floor after a fall, more than 24 hours after the fall had happened. And just like that, my client was responsible for all of the decisions: immediate medical care, finding a new place to live, taking away the car, and later on handling the sale of the home. Although the parent had been wonderfully organized, her illness had taken a toll, and it was clear that the person who was next in line, so to speak, didn't know where what the accounts were, where the papers were.
Thank you for sharing, Ambari. Certainly it's not fun to think about these things, but you can see it's actually a gift to your loved ones and survivors if you're prepared ahead of time. Now, as we mentioned, this new role of CFO can manifest in different ways. If you become a widow or widower, or you're newly divorced, there's going to be some overlap in similar items that need to be addressed, but there's also going to be unique situations in either one of those scenarios. In both of them, income is probably going to change. But first, I'm going to focus on how that impacts widows, and we'll be considering the survivor benefits on pensions and Social Security. Also, depending on the estate plan transfer of assets, investment income can change. If assets were awarded to other people, the surviving spouse's net worth and investment income may go down as well. It's also important to consider that your tax filing status can change. In the year of losing a spouse, the survivor is eligible to file as married filing jointly, and there's tax benefits and opportunities to do so. Additionally, the year following the passing of a spouse, you may be eligible to file as head of household. And then going forward, your filing status may change again to single. It's fair to say most people only go through this once in their lifetime. Those 3 different filing status have strategies that we can work within to maximize your benefit from reducing taxes. You're not meant to be an expert on this. That's why we want to make sure you can partner with somebody. Let's talk about how household income can change then. Suppose there's a couple, and together their combined Social Security income is $50,000 for the household. If spouse 1 passes away, spouse 2 will file for survivor benefits. But all of a sudden, the household income changes from $50,000 to $30,000. You step up to the survivors, or to whichever spouse had the higher Social Security. That's now the Social Security benefit that's claimed, and the other one goes away. So how will that affect your ability to be financially independent? Will this have an effect on your day-to-day life? Now, in addition to less Social Security, do you also need to consider less pension income? So here's a scenario where let's assume there's a pension also. If your spouse has a pension, you have the option to choose certain survivor benefits. And it's important to understand that and how that'll impact you. This is typically a choice you make at the time of claiming your pension, and it is typically not something that you can change later on. So again, important to run these scenarios side by side and see what might happen. Now, if both of those things happen, depending on which spouse dies, there's going to be a wide variety of outcomes. So in this scenario, as a household, between both Social Securities at $50,000 and spouse one's pension at $50,000, their household income is a total of $100,000. If spouse one passes, household income becomes $55,000. But if spouse two passes first, household income becomes $80,000. So prior to a spouse passing, it's important to consider an appropriate survivor's pension benefit. And perhaps if it's causing a huge reduction in household income that you can't maintain your lifestyle, we want to try to find ways to fill that gap for you. Things like life insurance could be an alternative that can be used. Once you're a widow, you want to consider how this will happen and just accordingly, but doing so proactively, the surviving spouse is more likely going to be able to maintain their lifestyle. Now, if you're recently divorced, again, income is going to change. It may not be survivorship of Social Security or a survivorship of pension, but things may shift to maintenance, child support. Perhaps if you hadn't been previously working, now you go back and have wages, but Social Security options can also be considered down the road. Now, if your former spouse remarries after you, maybe remarries multiple times, it's possible that all former spouses can claim on that benefit, which can impact you, but it won't impact the individual claiming on their own record. Now, again, for tax filing purposes, if you're divorced on the last day of the year, you're going to file single. Again, you may potentially have the opportunity to file as head of household and then going forward filing as single status. So understanding the impact of that is something that you need a CPA or an advisor to help work through so that you can take advantage of maybe some opportunities within that window. Now that's your role as being a CFO. There's another role, and I'm going to pass it to Ambari, and she's going to help talk to you about your role as an investor.
Well, as if being a CFO wasn't enough, we wanted to help you understand what goes into the second role we identified of being an investor in the marketplace. So it's possible that investing is something that you're already very comfortable with, and it's possible that it's entirely new to you. People tend to be most familiar with it when they're saving for retirement in a 401k plan, for example. But of course, investments can be used in other accounts for other purposes as well. Regardless of your level of experience, after an event such as a death or divorce, it's necessary to review the investments and be able to answer a few high-level questions so you can make sure that going forward, you're confident about how your money is invested. From the timing perspective, the first need is going to be about any distributions from the investment portfolio. You have to reevaluate because, as Libby demonstrated, there might be a need to increase withdrawals to supplement the loss of other income or make other adjustments for the needs of one person. Changes to distributions means that you're going to want to think about your risk tolerance, how you feel as the market reacts to periods such as COVID or certain geopolitical events. And also think about how much growth you may want the portfolio to generate. With that in mind, there are two high-level questions we suggest you ask yourself. One, what is your current comfort level with risk? Meaning, are you familiar with how much the market swings both up and down and changes the value of your accounts? What is your comfort level? This is called your risk tolerance, and it can change over the years. Two, is your portfolio diversified, or is it dominated by certain companies, such as technology companies? If so, we recommend moving to a more diversified portfolio so that it reduces the influence of any one company overall. At Savant, we're very aware of the costs associated with investing, and we focus on using low-cost index funds wherever possible. But investors have a choice on whether they want to use mutual funds that are passively invested and tend to have lower costs, or actively managed and tend to have more higher costs because of the labor involved. In fact, we're comfortable using both styles, passively managed where the market segment is mature, or using active fund managers where we want a seasoned manager to closely monitor the investments in smaller portions of the portfolio. As an investor, you may also have certain values that you want to reflect in how you invest. You may have heard of ESG investing, which stands for environmental, social, and governance. These are considered non-financial factors, and there are mutual funds that screen companies for the goods and services they provide, how environmentally aware they are. We've built portfolios to meet these interests, and please do not be shy about expressing your values when it comes to your investment portfolio. If any of these are concepts you'd like some more information about, please drop a question in the Q&A. Finally, one of the other important concepts is to ask whether your investments are being managed by a fiduciary. Working with a fiduciary means that you can feel confident the investments have no complex fees or hidden costs, and the advice is in your best interests. Now, going on, we thought it might be useful if we talked about a common scenario. This is where an individual retirement account or an IRA someone passes away and their spouse inherits it. You may or may not know, but the average age for becoming a widow is 59 for women, which seems quite young to me. And how old someone is matters because the law sets out certain ages, such as 59 and a half, 70 and a half, and 72, as one of the criteria for taking funds out of an IRA without a 10% penalty. The rules on IRAs do change, so you want to make sure you're looking at the current laws. One option is to roll the inherited IRA into your own. And that's a good option because you treat it as your own, allow it to grow, make contributions to it, and take distributions according to your own age. Remember, every dollar withdrawn from an IRA is considered taxable income. And the IRS does a great job of reminding you to create taxable income by requiring a minimum distribution taken out each year based on your age and the account value on December 31st of the preceding year. This is called the required minimum distribution, RMD. However, in our example where a young widow or widower needs money at age 59, they have the option of establishing a beneficiary IRA. With a beneficiary IRA, widows and widowers can access the funds at any time without a 10% penalty and don't have to wait till a certain age, obviously. However, this may require distribution of the entire account in 10 years. So that's an important factor. Understanding how to access your spouse's IRA will avoid any surprises at tax time. And we encourage you to make sure your personal situation and needs are taken into account when making the decision. And well, speaking of tax time, which we're all going through right now, as an advisor, I need to explain the tax treatment of different types of investments. Whether you are widowed and divorced, it's important to know what the consequences are when it comes time to sell an asset that you may have inherited or were awarded in divorce. All assets are not treated the same. Here are some of the most important terms to know. Other assets, such as rental property, there may be something called depreciation deductions that were taken over previous years. And when the property is sold, the IRS is going to apply something called recapture at a certain rate. So the words there that you may or may not be familiar with are depreciation, deduction, and recapture. For retirement plans, since every dollar from an IRA or 401k is taxable income, it's subject to ordinary income tax rates ranging from 10% to 37%. For non-retirement assets, the terms I'd like you to be familiar with are carry forward losses and capital gains. Carry forward losses. I know it doesn't sound like it, but carry forward losses are actually valuable. People undergoing a divorce will argue over these because they are used to offset future income, thereby reducing tax liability. You might want to check and see if you have any on this year's tax return. Capital gains. If you sell highly appreciated securities that have been held at least 1 year, then you may be subject to taxation at capital gains rates, which range between 0 and 20%, and can be more favorable than ordinary income tax rates that apply to withdrawals from retirement accounts. Another important concept to understand is the step up in cost basis. This applies to assets that are inherited when someone passes. Those assets receive a step up in cost basis, which increases the fair market value to that on the date of death. With a higher cost basis, the realized taxable gain will be reduced when the asset is sold. We like to reduce tax liability with this effective tool. And finally, if you're charitably minded, perhaps you want to donate appreciated securities instead of writing a check. This way you can avoid selling, realizing gain, and paying tax on the gain. You would then be able to take a tax deduction equal to the value of the securities. And now that we're on the topic of charitable giving, I'd like to move to our third role, that as a grantor and philanthropist. So the role of a grantor. This is a broad term because it includes the transfer of any assets to your heirs, as well as gifts made during your lifetime, whether to charities or the people you care about. A new wealth transfer plan will determine how assets are transferred through the estate plan documents. This is your opportunity to decide who should be involved and overall, what will your legacy be? When I say estate plan documents, I mean the collection of documents on the slide, a will, possibly a trust, powers of attorney for healthcare and property, and a living will. Each serves a different purpose. And I want to emphasize that the powers of attorney are for situations where the person is alive and needs someone to help them. In contrast, the executor role only goes into effect after someone passes. All of these documents should align with each other so that the transfer of wealth to the next generation happens smoothly and as quickly as possible. For beneficiaries, this is the way for you to avoid the probate process. You want to verify all beneficiaries on different accounts after a life event, such as a divorce or death of a spouse. For anything that you once held jointly, you may want to retitle them in your name. And add TODs or PODs, which are transfer on death or payable on death features. Again, this avoids the probate process and makes the transfer of wealth much more seamless. Not to sound grim, but you don't want your state of residence to decide how your assets are just distributed. We truly believe that every one of us deserves an updated estate plan. My personal plan was done in 2006. I think it's time for an update. I want to make sure that my documents include any digital assets because one of my clients told me a story about how difficult it was for her to get her husband's name off an account on her phone. And she got through it, but we can help people manage that. Libby, did you have a story you wanted to share?
Yeah, as a parent, this might not be something that you think of every day, or certainly you don't want to. But my daughter turned 18, and when that happened, there's also a transition of them going into adulthood. Your role as parent or mom absolutely has no legal bearing at that point. But when she turned 18, I recognized that there were going to be some things that I still wanted to help her with, things like college transcripts or grades. She's 18, she's an adult. She would have to give permission or request it herself, which as a transition she should be doing, but certainly there's things I wanted to step in, things like medical records or handling bank accounts. When she moved away to college, we wanted to be able to communicate and share money, but I needed to also have access. So you wouldn't normally think about getting power of attorney of property or maybe even proper power of attorney of healthcare for an adult child, but I highly recommend it. For example, then shortly after that, my daughter went through a major medical event. And again, the role of mom goes away. And I had to be the legal power of attorney to have the authority to make medical decisions on her behalf, as well as manage her bills and such while she was in the hospital. So there's a transition period of people becoming adults and you as parent where you can add some assistance with an estate plan as well.
Great, thank you for sharing that. So just briefly, I wanted to say a word about ethical wills. These are becoming more popular, and we do want to note it is not a legal document. It is a personal letter which communicates your values, your experiences, and your life lessons to your family. You might want to consider writing one and simply placing it within your file of estate plan documents and other important documents. So, and finally, on gifting, people tend to be very generous, and giving to charity and to children or friends and family can be emotionally rewarding. But please remember, your financial needs should be well defined and take priority. One strategy is to help the next generation or the recipient of a gift appreciate the value and become stewards of wealth, is to offer to match any money that they save. This can get the recipient more involved and also help you set some boundaries. We think that money earned is treated differently from money that's simply handed to you. And we're just wondering if you agree with that.
And it's fair to say, I'm sorry, Ambar, I didn't mean to overstep, but it's fair to say that gifting should be a gift. So when you're giving somebody money, if it's a family member or an adult child, you don't want to put strings attached. So I like that matching strategy because it gets them involved. Additionally, one thing that you can do is give small gifts and kind of observe, step back and watch how they handle those gifts. And then that can help inform your decision to do more gifting or less gifting in the future. Again, a gift is a gift, give it to them, but you can watch and observe and then shift your gifting strategy at that point. Now, we touched that there's going to be some major roles you have to play and how to organize them, and that there's going to be a lot of decisions to make. Ironically, a period of emotional turmoil is not the best time to make important decisions, yet a person finds themselves expected to do exactly that during this major life change. From what we have seen our clients go through, we have a few suggestions about establishing a decision-making framework, and we want you to find one that works for you. We recognize that adapting to this major life change is going to be handled differently by every person with different and unique circumstances, and emotions will present themselves at unpredictable times. So let's look at some of these questions that might come up. How much is too much? How will I manage my cash flow? Do I need to move or reduce my expenses? How do I handle taxes? Do I even need the insurance policy that I've had and paid into forever? What do I do with this rental property? How do I sell a business in which I'm a partner? How much can I afford to spend? So how do we help newly single people make decisions? One project that we do on a regular basis is to do financial projections. The single best benefit is seeing how decisions that you make in the short term can impact your long-term financial security. We need to start with your new normal and make assumptions about the income, about spending, about investment returns, and then test and stress the portfolio to see how that impacts the results. This can help gain clarity and confidence about your situation and give you the concept that you're able to plan for even the unexpected. Now, we're also very fond of checklists. Checklists can help you get organized, keep track of status items, be a useful communication tool, and help you mark your progress. Now, for our clients going through the loss of a spouse, Savant has a wealth transfer department that has created an estate administrator's checklist, which account by account, it spells out the timeline for the tasks and who is responsible for handling each of them. For our clients going through divorce, we have a post-divorce checklist. This helps make sure that your tax returns are filed correctly, the status is appropriate, that you're following up on your own estate plan updates and renaming your beneficiaries, among many other items. Now, you may have your own idea of a checklist. Perhaps you have a friend that's been through something similar and they have a useful tool that they used or learned a valuable lesson, maybe even the hard way. So it's good to know that there is more than one way to take care of this. And of course, we want to customize it and make it unique to you. Now, things like downsizing, relocating are major emotional decisions. And we want to make sure that we've incorporated what to do with the family home as a part of this, is generally that's people's largest asset, up there with your investment portfolio, maybe above, maybe the second largest asset that you hold. Now, so certainly we know that this is going to be a mathematical number crunching decision, but it's also largely emotional. If this is where you raised your family, you bought your first home together, do you want to even sell it? Maybe you don't want to, but you have to sell it. Maybe in the event of the divorce, both party wants it and you have to buy one or the other one out. Maybe you're a widow. And as Ambari pointed out, that capital gains can be a big impact. And depending on your filing status, you may be exempt from capital gains or a large amount of capital gains. So maybe selling in 1 year versus another is going to have an advantage. Maybe you want to sell so you can start fresh new memories and have a clean slate. So both of these things need to be considered, the emotional side and the number crunching side. Well, how are you going to know you're making the right decision? So this is where we want to do projections in various scenarios where we can play different outcomes side by side, and again, see how those decisions impact things in the long run. So once we have your new normal, we understand your pension, your Social Security, or your investment income and how that's changed, we want to prepare projections based on that information. Now, there's a lot of information on this page, but believe it or not, this is just a summary of an 80-page report. But I think it's important to illustrate the capability that this can add in making these tough decisions. So what we're going to do is take all of the assumptions that I just listed and stress them over a long period of time, your life expectancy, and then use different market returns and project them with 1,000 different market outcomes and scenarios. These scenarios will include the best case scenario, the worst case scenario, and then most likely what might manifest. This type of simulation is called Monte Carlo simulation. So we work to see what needs to happen to get our clients into what we call the green zone or the confidence zone of a 75 to 85% chance of success. And that chance of success is measured by how many of those Monte Carlo simulations are successful. Success defined as you not running out of money and meeting all of your financial goals. Now, in this scenario, we have a widow with $2 million of investable assets. She's already determined how much she's going to get by claiming Social Security survivor benefits. She knows her budget is $60,000 a year for lifestyle and $5,000 annually for healthcare. Now, on the far left of the screen, the base scenario shows that there's a 99% chance of success. So out of 1,000 different market trials, best, worst, and everything in between, she doesn't run out of money. So that's pretty rosy, but let's stress the portfolio a bit. Now, in the second scenario, we've increased her budget. Now that she is on her own, she wants to travel more. Maybe she has to go visit friends she hasn't seen. Her kids may have moved and now she wants to get out and about and go visit them more often. So we have to add a $10,000 travel budget for 10 years. And then we talked about gifting. So she wants to include that now into her financial plan, whereas before maybe she wasn't able to afford it, but now that there might be some money left over with this high chance of success. So that 96% success rate is also very positive. But in the third scenario, we run a scenario where at age 80, she sells her home and enters an assisted living. Now, the net expenses increase due to those medical bills, and her chance of success decreases to 79%. So we're getting a little challenged. In the last scenario, she wants to age in place at home. At age 85, she hires someone to help her in the home. She needs skilled care for the last 2 years of her life. Now here, the percentage is still in the green zone. So all these scenarios, in order to come up with these numbers, we have to use an average annual market return based on the way the portfolio is designed. But again, we also look at the timing of market conditions relative to all of this happening. So think of a person retiring in 2008. If the market has a significant decline in the first 2 years of portfolio distributions, the recovery trajectory can be challenged. And again, that is factored into these success rates. But the software assumes that you spend the same amount every year. But in the event of a serious market decline, you and your advisor will work in real time and suggest maybe some changes that need to be made. Maybe that's a year you don't spend that travel budget, or maybe you put off gifting in order to increase your chances of success. Bad timing for scenarios in the last two scenarios, 79 and 82% success, are straining the outcome. So now we might want to look at some other options. Maybe she needs a new insurance policy with long-term care. Maybe getting a life insurance policy that adds that in. So when we find a weakness in a plan, which we typically try to do, then we try to find a way to fill that gap. That's how we can manage by seeing these side by side. Now, in this scenario, we have a divorcee with $2 million of investable assets. She will claim half of her former husband's Social Security benefits. There's no pension here, but she will be receiving $60,000 of maintenance and child support until her kids are 18, paying into a college fund for the first 5 years. And here she has an 85% chance of success with those variables. Now, in scenario 2, what if that spouse has a premature passing right away and she doesn't receive the maintenance and child support as expected? Well, here the results are poor at 69%. We're not in the confidence zone. So if we're preparing these projections proactively in the negotiating stage of a divorce, now you can include something like life insurance, again, to fill that gap as part of the settlement. Now, in scenario number 3, let's say the projections are prepared after the divorce is finalized and it's too late. There's no insurance. So now what do? Well, in this scenario, if the maintenance and child support goes away, now we look at selling the home and using the proceeds of that home to add to the investment portfolio. And now we're able to get the success rate back up to 85. And in number 4, in the last scenario, she receives full support, stays in the family home, but now she needs end-of-life care. Her results are low in the confidence zone, so she might want to make some adjustments, but it's still in that range. So you can see by putting these different scenarios side by side, without knowing which one of these scenarios is going to happen or what's going to cause a loss of income, at least you can have an idea of how that's going to impact you, and then also an idea of what type of planning tools can be used to fill that gap. Bari, I know you've worked people with these types of scenarios, and certainly you work as a financial advisor, and I know you have a way to kind of help overlap this with our clients.
Oh, yes, Libby. I think doing a retirement projection such as the one you showed is really one of the tools that can provide a great sense of financial security to someone and answer questions, can I afford this? So a really very, very important tool, I think, to help people feel confident. So yes, as an advisor, I know that some of the questions that commonly come up are the ones that Libby showed you earlier. We recognize to answer those questions, you may need to engage a qualified professional to explain your options so you can decide what is best for you. When someone tells you you are not alone, please believe it. You can work with somebody your friend referred to you, someone you found on a search, or someone who simply lives nearby. But chances are that professional has already helped someone through a life event, such as the one you're going through, and you should certainly ask them about it. One of the challenges that you may find in coordinating this team of advisors, attorneys, CPAs, and agents and realtors is coordinating everyone, and that falls on you. However, as a financial advisor, Libby and I have been on calls with estate planning attorneys, CPAs, and agents to make sure that any questions that come up are resolved, keeping the larger financial picture in mind. And the purpose of coordination is to make sure that there are no gaps, no conflicts, and no surprises. And finally, I simply wanted to acknowledge that in our discussion of how to approach decisions, the simple truth is that money and emotions collide during major life events. And as an advisor, it's a real pleasure to learn what someone's unique relationship with money is, how they believe it should be used, grown, and protected. We have the utmost respect for our clients' wishes and hope to create an environment where talking about finances feels positive. So somebody who finds themselves unexpectedly solo can move forward. I hope our presentation has encouraged you to express your own views and ask many questions. Libby?
Throughout this presentation, we've mentioned a couple of times that there's some resources we can offer. Now, if you'd like some of those, please let us know in the survey and we can email it to you. But here is a quick list and let's review them. So I mentioned the Estate Administrator's Guide. This is your financial footprint, which documents your assets, liabilities, income, expenses. It should include life insurance, portals, passwords, people to notify, memberships to cancel, credit cards to cancel, much more. It can be a very comprehensive list. And your family will need this when you pass, so it's good to keep it updated. We also have the Estate Administrator's Checklist. This is a chronological checklist of tasks to consider and complete once someone has passed away. We also have the post-divorce checklist, and as that name indicates, all the tasks which need to be done to achieve closure after divorcing. The Ideal Futures Health Assessment is a survey that can help you determine where you are with your financial planning. We look at 10 key areas which we believe to be most critical to your financial security. Those include things we've covered today, things like portfolio management, taxes, charitable gifting, education planning, and so on. And then finally, we have the risk assessment. This is a survey to help measure your appetite and tolerance for investment risk. This is used to help determine which risk profile suits you best as an investor, and we partner with you to come to that conclusion. Our clients really appreciate these resources, and again, we're happy to share it with you, so please just ask. That pretty much wraps everything that we have to present today. So I want you to take your time. When you're going through something like this, accept help, document everything, and it's okay to delegate to various professionals. You want to find those allies to help you, and you want to think like an individual, and you need to create a whole new plan moving forward. You want to take advantage of educational opportunities to feel more comfortable in these roles, because the more you learn, the less intimidating it becomes. Again, you want to think about acting like a CFO. You want to start thinking like an investor, and you might want to start thinking as a grantor. If you previously had all your assets left to your spouse and your spouse is no longer there, you have a whole new world open to you of things to consider. Savant has resources such as these educational materials, but we also have groups that are focused on special initiatives, and we have a women's initiative, and then presentations such as this focusing on becoming single through a variety of different avenues. And hopefully we'll be able to do in-person events and networking events so we can get to meet one another soon, now that things are starting to feel a little bit safer to engage. Also, it's important to revisit your estate plan. Again, not fun, not exciting, but it helps to make sure that all of your intentions are going to be carried out. And you want to simplify and consolidate everything because, again, having that sense of control can help with the healing process. So now, if you've submitted any questions in the Q&A box, we'll pull those up, or you can start typing those in now. And of course, thank you for participating in today's webinar. The first question that I have here, a lot of times when we're dealing with people in the investment process, it doesn't happen in a vacuum. Current events, news headlines, things are constantly revolving around us. Certainly in the recent years, it was the COVID-19 pandemic and how that impacted things. Prior to that, we were in an election cycle that was highly contested, causes a lot of uncertainty and concern for investors. And today, a lot of the questions that we have coming from investors are about the current crisis between Russia and Ukraine. One of those questions is, how much exposure do my investments have to Russia? Well, I can tell you that Savant does employ international investing in both our equities and bond components of our portfolios. We also have different categories of international investing, and Russia is included in some of those emerging market categories. Now, I can tell you that in our stock funds, the exposure is less than 0.5%, and in our bond funds, on average, it's less than 1%. The currency exposure to the ruble was removed as voted by the fund managers back in February. And for the most part, we don't have a lot of Ukraine exposure. Another question that people ask is, well, how do these political events impact the market? We see what's going on, but what does that mean for me? Well, we want to put some context around that to give you some comfort and peace of mind as much as we're able to in uncertain times. But what we can do is look at past geopolitical events that created a great deal of uncertainty, and we can look at how those events impacted the S&P 500. So we can put a list, things like Pearl Harbor, the Kennedy assassination, 9/11 terrorist attacks, certainly all very scary episodes that we've been through. And what we can see is that on average, it took about one or 2 days to go to the bottom of the market, or 4 to 6 days to go to the very bottom of the market. So before we hit the bottom and started going back up, it could take maybe a week or so of trading days. But then from there, on average, it took about 19 days to recover those losses. So there's a lot of different ways to look at how the market has been impacted in the past to help get some certainty that we will get through it this time. And Ambari, do you see the next question? Do you want to cover that?
Oh, sure. So I've got a question. How do I know how much I can give to charity or my family without hurting myself? Well, I would say that one of the best ways to protect your needs is really to be honest with yourself about how much you need to spend on your lifestyle, on your medical care, and any goals that are important to you. Once we have that figure, it can be tested in a retirement projection to show that it's sustainable, or if any adjustments need to be made. And then you'll know that any additional funds can be safely gifted. For charitable giving, you may also want to understand any tax benefits associated with a charitable gift. So I see one other question here, and I think both of us could address it. It's please address any differences in approaches that should be taken if the partner knows in advance that they will be solo in the near future versus unexpectedly solo due to a known terminal situation. Great question, and I'm sorry for your circumstances. But yes, putting those power of attorneys in will enable you to take care of the person who has the illness, reviewing that person's accounts and becoming familiar with their situation will help you identify any actions that need to be taken with respective accounts and institutions. Libby, did you have anything to add to that?
Well, and like you said, in a terminal situation, that's a lot more certain, right? We know at least the timing, we know that it happens and when it happens. A divorce is a process, and it can take a long period of time for things to get resolved. It doesn't happen overnight typically. Often there can be emotions involved, which is going to make it a contentious situation. So now you got the court system involved, then you have court dates that push things out, and then lawyers are going to give you pieces of information that you wouldn't have considered and how you might be reevaluating how you want to approach things. So it's important to recognize that that is a lengthy process. It doesn't happen all at once. And again, all those decisions don't need to be made at once, but knowing various outcomes through planning can help you to make those decisions during that period of time. I also had a question about IRAs. There was a couple that had different balances in their IRAs. Now, IRA stands for individual retirement account. There can be no joint IRAs. So even if you're married, you will have an IRA in your name and your spouse will have an IRA in their name. And if there's large differences between them, one person asked me, can I take some of his IRA and even these things out? During marriage, the answer is no. During divorce, that's when that can be split and things can be equalized and divided. So there's different ways of accomplishing things, but there has to be different scenarios, and we have to understand what's going on in order to make that happen. I know we talked about values-based investing and how to make a decision about screening your portfolio for things like sustainability, reducing carbon footprint. Those types of things can be screened. And I always look at it as, if that's something that you do in your day-to-day life, are you the type of person that is buying an electric vehicle? Maybe you've installed solar. Or maybe when you're shopping, you flip over the back of that product and you read it and you understand the company, and you know there's certain companies that you want to avoid, or maybe ones that you want to support. If you're doing those things in your day-to-day life at that time, I think that's the type of person I would want to talk further about the investing where we're screening those funds. But if that's not something that you're doing in your day-to-day, I don't think you need to feel pressure to add that to your portfolio strategy.
Yes, and Libby, I would just say that, if you're talking about ESG investing, these fund managers will have as investment objectives, they want to find companies that have fair labor conditions, operate sustainably, or have anti-corruption policies in place. Some funds may screen out entire business activities. Or we're even finding fund managers are deciding not to invest in companies because of a culture of unprofessional behavior. So these are all things that are very current, and investors are able to express their views. I just wanted to share that.
Thank you, Ambari. Well, I think that about wraps up what we wanted to cover today. If you didn't ask a question, maybe something comes to you later, certainly feel free to submit it. Now, as you close out of this, a survey is going to pop up in your web browser when we close out. So if you have any specific questions that we didn't address, please put them in the survey under follow-up questions and comments. And if at any time you're looking for more information about Savant and what we do, please go to savantwealth.com and learn more. Thank you for being my partner today, Ambari, and thank you everyone for joining. Have a great day.